equities in general are positive compared to 2013. We think Asian equities should generate positive returns, unlike most of 2013, where it was just about flat across the year. And in that context, even in India, we think that we're possibly past the worst as far as the macroeconomic data is concerned. Growth has recovered slightly. The deficits, current account and trade deficit, have declined. And the only thing that needs to recover perhaps is the investment cycle. And that is the variable that could potentially add a significant degree of re-rating to the equity markets. As of now, we are not really seeing an improvement in the investment cycle. To some extent, it could be contingent on the political environment as well, because I think a segment of the corporates are looking at more pro-business government formation as the center. In this context, I would mention that the markets have moved up significantly on the basis of this political hope in near term. And that's been bolstered by the state election results. But having said that, we must also caution investors about reading too much into this, because first of all, it's premature. Historically, we have seen that the state election results don't necessarily translate into a very similar election result at the central level. And therefore, the deep cyclicals like public sector banks or the industrials, the second-tier infrastructure companies that have run up very sharply, we would advise caution on that universe. And the sectors that we like are related to two segments of the economy, that is private consumption and net exports. So we are still recommending overweight stance on IT services, pharmaceuticals, the merchandise exporters like some in autos, and very select consumer-orientated companies which are strongly correlated with rural consumption, the likes of the tractor makers or the tobacco majors like ITs.